And our objective with Diligence, although we don't write a check in that first meeting, is to get to as quick a yes or as quick a no as possible. So, all the founders on the listening to this podcast will know that your fundraising journey is brutal, and it can be a massive distraction away from what you want to be doing, which is growing the business. So for us, any kind of no from an investor is painful, but our view is a quick no is much better than a slow no. So that first touch point, that first meeting that we have internally is can we see a path to making an investment here? And if not at that particular time, and we have said no to investments and then paid the price by paying a higher price later. If it's a no, then we let the founder know at that point and give them some feedback and hopefully stay in touch potentially for future rounds.
Hi everyone, welcome to episode 113 of the Startup Playbook podcast. I'm your host Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, the strategies they used to succeed, and their advice to current and future entrepreneurs. I'm delighted to have Elicia McDonald, the investment principal at AirTree Ventures, as my guest for this episode. Elicia started her career as an investment banker before jumping into the world of enterprise sales, first at a B2B SaaS startup and then at LinkedIn. She then moved into the world of VC, joining AirTree, one of the leading VC funds in Australia with over $500 million in funds under management and a portfolio containing some of Australia's best startups. Since joining the fund in 2016, Elicia has played a pivotal role in the fund's early investments into successful startups such as Huddle Insurance, Expert360 and Different, and in 2019 was promoted to the role of investment principal. We covered a range of topics in this interview, including how to do due diligence on your investors, when and how to nail your first meeting with an investor, the characteristics of investable founders, a deep dive into AirTree's due diligence and investment process, and what metrics you should focus on. Without further ado, here's my interview with Elicia McDonald. Hi everyone, welcome to the Startup Playbook podcast, episode 113. Delighted to have Elicia McDonald as our guest for this episode. Before we get into this interview, a quick welcome and thank you all for joining us this morning. Early start at 8 a.m. For those of you that are joining us for the first time, just a quick rundown about how this podcast and the structure of this live episode will work. So for the first about 40 or 45 minutes, Elicia and I will do the podcast interview as per normal, and then we'll shift gears and move over to Q&A. So thank you to all of you that have submitted questions through the registration process. There's also a little Q&A tab at the bottom of your screen. So if you've got any questions while we're doing this interview, please submit them. We'll do our best to try and get through as many questions as possible. I'll pick out a handful towards the end of this episode. But once again, thank you all for joining us. And Elicia, welcome to the Startup Playbook podcast. And thanks so much for taking the time to be on the show today.
Thanks, and thanks for having me.
So Elicia, for those people that may not be as familiar with you or your background, do you want to share a little bit about your story and what got you here today?
So I grew up in southern Sydney. I can't say that when I was young, I knew I wanted to be a VC when I grew up, but I would say technology was always a reasonably big part of my life. So my dad was an electrical engineer. He went on to become a VP at Cisco. Both my brothers, I'm the youngest of three and the only girl, both my brothers ended up in the technology sphere as well. So one is a systems engineer at a Wi-Fi startup that was acquired by Juniper, and another is a cybersecurity engineer. So tech was kind of always a constant. But when I graduated from school, I decided to study commerce law at the University of Sydney. And I went on to then follow a reasonably typical path of becoming an M&A banker in a bulge bracket investment bank. And I did make sure, given my interest in tech, that I joined the tech media and telco coverage teams when I was a banker. But it didn't take me long to realize that banking wasn't the right career for me longer term. I learned a heap. I met a lot of great people, learned a heap of really valuable technical skills. But for me, I also learned a lot about what drives me and what I'm passionate about, and there was definitely a misalignment there. So then I took a sort of more atypical path, I guess, and I decided to join a B2B SaaS startup that was creating P2P fundraising tech for charities. So I joined them in a business development role, and I was doing everything from prospecting to relationship management and everything in between, as you can imagine, in a small team. And then most recently, prior to AirTree, I was in enterprise sales at LinkedIn. So I was at LinkedIn for 3 years, and I was there from when there was probably about 100 people in Australia, and then maybe around 350 when I left 3 years later. And my role in enterprise sales there was to sell LinkedIn as a recruitment platform, LinkedIn Talent Solutions suite of products to help enterprise businesses recruit top talent through LinkedIn. And I loved my time there. But then when the opportunity came up to join the investment team at AirTree, it was an opportunity. It was too good to say no. And that was 4 years ago now. So I'm now a principal in the investment team at AirTree.
Yeah, and obviously we'll kind of dive into a lot of your sort of experience with AirTree as well. But one of the fascinating things about doing this podcast is just kind of hearing back about the journey that a lot of the founders and the guests that I've had on the show have taken to get to the point that they're at now. And as you mentioned, you had a relatively traditional kind of move out of university to move into investment banking, but you decided relatively early on that it wasn't the right fit for you. And I think that's probably something that a lot of founders probably resonate or relate to it at some point as well. What did that process look like? I think, again, one of the things that's kind of been highlighted through my own experience as well as talking to the guests on the podcast is sometimes there's almost an overabundance of opportunities when you kind of realize that what you're doing isn't the right thing and you want to go and do something else. What did that process look like in terms of deciding that you wanted to move into the startup space specifically and into business development?
Yeah, so, like I said, I didn't really know what I wanted to do when I grew up. I didn't have this very clear vision of what I wanted to do. I think that'll probably make things a little bit easier, but I think a lot of people these days don't know that when they're 18 or 22 and they're graduating university. So for me, I knew at that point what I didn't want to do, and I knew that tech was an area that I really loved. I think my parents had a massive influence on my decision to leave banking, just sort of moving away from that more traditional path. I remember they could clearly see that I wasn't loving what I was doing, and they said, "Oh, you should quit and try something different." And for me, that was just, how could I'm not a quitter, like I can't possibly fathom that. And then, they sort of helped to reassure me that I'd worked hard at uni and school to do something that I loved, and at a young age, it was okay to try different things and try to find that. So it was actually my dad specifically who suggested tech sales, given that's sort of the area that he was in. He knew I loved people and loved to talk. I've always been a chatterbox, and so I went down that path, and I guess they really helped me to think beyond the bubble that I'd been in at uni, around sort of banker, lawyer, consultant, and see beyond that. I do remember when I resigned from Credit Suisse, there was a lot of people thinking I was pretty crazy. At that time they were very much used to people leaving to go join a large corporate or a PE fund, but not some little company no one had heard of. So I do think that's changing. I think it's becoming more and more typical for top talent to want to work in tech and startups, which is super positive to see. But yeah, I do remember having some strange conversations where there were some puzzled looks, and I just knew, I tried something different, learn a new skill set, and obviously worked out well for me.
Yeah, I mean, I think I've spoken about this previously on the podcast. My friends actually had an intervention for me when I decided to quit my engineering. So yeah, they were probably half wrong. And I think a lot of that sort of comes from safety and I guess people's own experiences and things like that. So it comes from the right place. Doesn't necessarily mean it's the right thing though.
Yeah.
So kind of shifting gears again, just talking about your sort of LinkedIn experience as well, what were some of the things that you learned from enterprise sales? And I think, again, we kind of briefly spoke about this a while ago in terms of just skill sets and just value add that's kind of individual investors provide to a portfolio fund. What were some of the things that you picked up from your background as an investment banker, or as working at a B2B SaaS startup, as well as from LinkedIn, that you were able to sort of take on and help with your companies at AirTree?
Yeah, so I mean, there's a couple of buckets there. So when I was actually at LinkedIn, I started in a sort of sales analysis role. So LinkedIn was super exciting for me in the sense that they had so much interesting data, and I loved pulling all that together. And we would use that to then communicate ROI to customers. So it was a very sort of customer-facing role, but using that data to tell that story. And then I sort of moved into a product specialist role, and then eventually into the enterprise sales role. So I guess across those roles that I had within LinkedIn, super useful in terms of the enterprise sales side of things. I know the pain of negotiating with procurement and territory planning and incentivizing sales reps with comp plans, updating CRMs and forecasting and all that sort of heavy lifting that if you've lived and breathed it for a few years, you understand what it's like when I'm sitting around a board table now and we're talking about those issues. I also, from a LinkedIn perspective, the actual HR solution side of things, because I was selling a talent product, is actually really applicable to the work that I do with startups now, because so much of what we talk about is how do we get great talent on board, how do we retain them and incentivize them. So that comes in really handy as well. And then on the finance side, you can probably tell my passion is more sort of people and product, but the financial skills that I got both through university and then also in investment banking definitely comes in handy. I feel very comfortable in the spreadsheet. Going through a diligence process is a lot sort of unpacking some of those metrics and the financials around a board table where we're doing the same thing. If it comes to both AirTree doing investing or with our portfolio companies going through follow-on fundraising rounds, running the cap table and being comfortable in all those numbers definitely comes in handy. But if my passion lies more on the product and people side.
Like that's really interesting insight for founders as well to know. I think you had a post around doing due diligence on your investors as well. And I guess part of, one of the kind of common themes is that, I guess now the ecosystem's at a point where we have multiple different funds. A few years ago, we didn't have, founders didn't have as many options, but there's a lot more kind of opportunities out there. And I guess VC funds have a kind of a tighter area of focus in terms of kind of their investment thesis and what are the kind of core industries or business models or verticals that they sort of focus on. What should be the first step for a founder who is looking to fundraise for the first time, and it's potentially their first startup and first time looking to fundraise? What should be their first step in deciding who they should be speaking to, who they should reach out to, how they should be reaching out to investors? Do you have any advice on founders in that situation?
Sure. So I think the first step is to do a little bit of desktop research. So we have so AirTree has open source VC, which is sort of a content hub on our website, our website is airtree.vc, and then under one of the tabs you can see open source VC. And that's essentially our open source VC, a lot of content to try to demystify the fundraising process and make it as transparent as possible. And the reason I mention that is one of the resources on there is an investors list, which has a list of all the investors in Australia. It's open source. People can continue to add their information in there. So if you're an angel investor or a fund that's not currently, jump in and add yourself. But the idea is a founder can use that as a starting point where they can have a look for investors that invest in their stage. So if you're a seed stage, if you're raising your seed round or a pre-seed round, it's probably not going to be the best use of your time to talk to a fund that only does growth stage investing. So that should be a starting point to understand what are your requirements for the fundraise, and then what investors meet that threshold in terms of the stage and the sector. As you mentioned, as the ecosystem grows, people are becoming more focused and might look at certain stages or certain industries specifically. So just making sure that you're using your time wisely by prioritizing. So starting with that, I guess, broader list, narrowing that down to a list of people that make sense based on how much you're looking to raise and what you're looking for out of the partnership. And then I guess the next step is, once you've got that short list, is starting to reach out to them and meet them. And there's so much that you can tell in that first meeting in terms of the relationship between you and the investor. And it is a really important dynamic. As you mentioned, I've written a whole blog post on why you need to diligence your investor. It's often a decade-long partnership, and so making sure that that is a good dynamic, and you can see that investor can add value, and the partnership's going to be a strong one over 10 years is super valuable. So I would say reach out to them. In terms of how to get in contact, for us, our job is to make investments, and so we want to be as accessible as possible. So we're all on Twitter, LinkedIn, all our emails at AirTree are our names. I'm Elicia at airtree.vc. If you have a connection through your network, great, use it. But if you don't, we have a link on our website. Contact us for investment. We can submit your pitch deck. So really, VC should be as accessible as possible, and that's the approach we take. So there's no need to use any sort of formal advisor or anything to get in contact with us. We're there, and we're open to people reaching out and wanting to have a chat.
I'll make sure I link your blog post and your email address into the show notes at startupplaybook.co for anyone that wants to follow up with that as well. But Elicia, one of the things that obviously a lot of investors talk about is wanting to meet with founders as early as possible through that process, just to get to kind of know them. And obviously there's the whole kind of saying about investors sort of invest in lines, not dots, and you kind of want that very first reference point. Is there a point where it's too early for founders to meet with investors in the stage, in the sense that does it become harmful for them if they haven't quite sort of fleshed out specifically what their business model is like, or even what their idea, or what market they're focusing on? Like, from your perspective, what should that sort of ideal first meeting or that first reference point look like from your perspective?
Yeah, and I think we often see people that are reaching out to us for the first time when they are kicking off a formal fundraise process. But to your point, we often have meetings with founders that and there's multiple examples in our portfolio of founders that we've invested in, and the first time we met them was years earlier, and that's not only beneficial for us to get to know the founders before that point, but also, as I mentioned, it gives the opportunity for the founders to get to know us a little bit better over a longer period of time. So it's useful on both sides. In terms of how early is too early, I don't think there's a perfect science there. I think if you don't know the problem you're wanting to solve or the market you're going to target, that's a bit tricky. I mean, for us as investors, we're going to look for what's your passion to solve this problem and why are you the best person to solve that problem and to create that vision of the future that you want to bring to life. So if you don't have any idea of the sort of area you want to target or the problem you want to solve, it's probably a less compelling story than if you come to us, without a product. That's fine. Pre-product is fine. Pre-revenue is fine, of course. I think having some idea of what's driving you, what problem you want to tackle would be super useful, because then we can see, this is an amazing founder with, the kind of qualities that we'd look for, and they want to tackle this problem. How they go about that, they still need to work out and figure out the product opportunity. But I'd probably say that, to have an idea of what you're trying to solve would be super useful.
You just touched on kind of one of the other sort of common key points that a lot of investors talk about, as well as, essentially focusing on the founder more so than the solution or the idea. Especially at the very early stages, there are just so many variables that kind of come up through the process. Essentially you're kind of backing the jockey to sort of figure out the strategy or kind of make necessary pivots moving forward. How do you sort of assess that without having a great amount of sort of data points there? Like when AirTree or you specifically kind of talking about looking for good founders or being the best placed founders to solve a particular problem, what are some of the kind of key characteristics or background or experience that you're looking for to give you better conviction that they're the right person?
Yeah, and again, this is not a perfect science, and if you develop an algorithm, probably none of us would be in a job anymore. So, and like I said, I love people, so this is a part of the job that I find fascinating, and there's nothing more exciting than having a first meeting with a founder and leaving it just sort of super excited about their potential and what they can create. And that's, I'm honestly feel pretty lucky that I'm in awe of the founders that I meet on a daily basis, and I get to be part of a very small part of their journey, which is super exciting for me. But in terms of what makes me special, I mean, the qualities, I've already touched on in terms of, having a visceral connection to that problem, and we really try to unpack particularly in that first meeting when we're first trying to sort of understand them as a team, because fundamentally, particularly at the early stages, where a huge part of our investment thesis is that team. And as you mentioned, market dynamics change things, change products, will pivot. But if you've got the right team to navigate that, then that stands you in good position. So we'll look for people that have that visceral connection to the problem. Use that opportunity, that first meeting, to share your vision of the future and why you're best placed to create that vision. And then I would say, also the ability to evangelize the product and bring other people on that journey with you. So you can't do everything alone as a founder. At some point, as you scale a business, you need to bring in exceptional talent to help you scale it. You also likely need to bring in additional investors over many rounds if you want to continue to go through to a growth round. So can you inspire future employees? Can you inspire future investors? And that's what we'll sort of look for. I think there's other super useful characteristics like commercial hustle, resilience to pivot when needed, even things like just self-awareness to adapt in a rapidly changing environment. I mean, we've been through a crazy period in the last few months, and I think in startup land that's always the case, that you're navigating these changing dynamics. So founders are well placed during that. And then I guess in terms of, if you look at sort of a founding team and go, well, what's the ideal balance? You always talk about complementary skill sets in the founding team, and to be fair, you can plug gaps through hiring. And so if you've got a really strong ability to bring in great talent, we'll sort of feed through that and say, okay, they've got 2 of the 3 covered and they can hire the rest. But for us, I'd say it's someone who's setting the product vision. It's normally the CEO, somebody who then is technical and can bring that vision to life, and somebody who's focused on growth. So if you think of Cam, Cliff, and Mel at Canva, that's sort of the ideal balance. And like I said, you can plug gaps with hiring, but that's the kind of skill set we'd be looking for in a nice complementary balance across the founding team.
So much great advice and insight over there. One of the things that I wanted to kind of hone in on, you kind of spoke about the need to evangelize, like essentially being an evangelist to bring on investors or bring on potential new staff, or even to sell to customers. again, one of the things that may be based on what people see on TV shows or on movies, especially for first-time founders, is potentially this impression that the first time that they meet with an investor, they'll bring a checkbook and sort of write a check for $1 million, which isn't the normal process that kind of goes down, especially in Australia. Oftentimes you'll need to go back into your team and sort of obviously have kind of multiple meetings, but you will essentially need to be an evangelist within AirTree to try and convince the rest of the team members to come on board with the investment. What are some of the things that I guess get you excited, or what are some of the things, like how can founders sort of reverse engineer that process a little bit and get you excited enough and I guess build enough conviction to go and really push this internally?
Yeah, and I think to sort of clarify on our investment process, we'll have that first meeting, and unfortunately we don't bring a checkbook along to that. And it's not I think that when we talk about evangelizing a product and bring people on the journey, feeling like you have to have some perfect polished pitch, it's just not the case. We don't have that first meeting is not sort of us saying, okay, pitch give us the elevator pitch in 10 minutes. It's not sort of how it works, and there's no need to step through a deck or anything like that. So I would say the most powerful thing a founder can do when you're going through that fundraise and wanting to make a powerful first impression, so that the person that you're speaking to can go back to the rest of the team and convince them, which is a big part of the investment process, is to use that time to allow the investor to get to know you and your passion for solving that problem, as I mentioned. So for me, it would be sending across a short deck before the meeting, so that we can use the time together as a conversation and really understand if there is that partnership there, and to unpack those motivations and focus on the questions coming out of the deck versus going through all the basics, and using that time just to step through that. So if you do have materials beforehand, send them across. Having the meeting, also having questions ready for the investor, because you also need to do diligence on us and make sure it's the right fit for you. And then, as you mentioned, our job from that first meeting is to then go back to the rest of the team, and we have a meeting once a week where we discuss new investment opportunities that we've come across, and as a team we'll have a conversation around that. And our objective with diligence, although we don't write a check in that first meeting, is to get to as quick a yes or as quick a no as possible. So all the founders on the listening to this podcast will know that your fundraising journey is brutal, and it can be a massive distraction away from what you want to be doing, which is growing the business. So for us, any kind of no from an investor is painful, but our view is a quick no is much better than a slow no. So that first touch point, that first meeting that we have internally is, can we see a path to making the investment here? And if not at that particular time, and we have said no to investments and then paid the price by paying a higher price later, if it's a no, then we let the founder know at that point and give them some feedback and hopefully stay in touch potentially for future rounds. And then if it's a yes, we can see a path, and we jump into a diligence process, and I can talk more about that, but it will look different depending on the stage of the business, and then we go through a process from there.
Yeah, would you mind kind of sharing what that diligence process looks like as well? Like, I think that might be a little bit of a black box for a lot of founders on the other side of the table. So it would be great to get some insight into what does that process look like when you've got that sort of initial interest in or a potential for an investment opportunity.
Yes. I think this is the same approach, in that we're trying to get to as quick a yes as possible. So I think it can be dangerous if an investor is kind of saying, okay, give me all the possible information you can possibly give me, and then I'll work through it and try to find the answer. I think for us, it's using that first internal meeting that we have in discussion to figure out what are the key concerns from the investment team. So if we need to get across the line from an investment perspective, is it concerns around go-to-market, is it the product, and really honing in on those issues and focusing the diligence process around that. As I mentioned, the diligence process will look quite different. A pre-seed, pre-revenue, pre-product investment is going to look very, very different to a Series C, just in terms of the financial diligence and metrics. But to be honest, the kind of things that we include in a diligence process, there are some things that will fall across all those stages. So spending time with the founders is obviously a big one. Spending time with the broader team, so spending time in the office, getting a feel for the culture, speaking to the different execs in the team is a big part of it. Running through a product demo, playing around with the product, understanding what the customer experience is. Speaking to customers, we typically backweight that in our process. It can be dangerous for founders to open up their precious customers to a whole range of investors that might just be poking around and somewhat interested. So we try to make that one of the final steps in our investment process to protect founders' customers. And then, doing the financial analysis, we'll normally run through a financial model, metrics, and we essentially pull all that information together into an investment committee paper. So that's a paper where we'll use internally to make an investment recommendation. And then right at the end of, so put that together, we've had our investment committee meetings, which are weekly, to discuss and flesh out those issues in the potential investment, and paint the vision for the rest of the team of what this could be, which is, obviously a big part of our role. And then right at the end of the process, we have what's called a partner presentation. And that's probably the more formal, pitch that people would imagine that might come earlier in the process. But for us, that's really an opportunity for the founding team to get to know the broader AirTree team and vice versa. And for us to hear you, talk through your vision. We always promise not to interrupt founders too much when they're doing their pitch, so they can sort of go through that, and then we have a discussion afterwards. But we inevitably have questions, and it turns into more of a discussion and collaborative session. Post that partner presentation, we can issue a term sheet sort of immediately. That's the idea, is that we move straight towards a term sheet. And by that part of the process, we would hope there'd be no surprises in the term sheet. We've actually open sourced our seed stage term sheet on our website under the open source VC content I mentioned earlier. So the idea is that we want to be as transparent as possible. So by the time you come around to getting a term sheet from us, you know exactly what to expect, and there's no question marks. And for us, I guess that process from the first meeting to getting a term sheet, around 4 or so weeks, is probably the rough guideline.
Yeah, just speaking about open source as well, and kind of shifting about, talking a little bit about kind of AirTree's strategy as well. I think AirTree has definitely led the way in the Australian startup ecosystem of kind of sharing resources, documents. I think you've got a very comprehensive investor list as well, which is a great sort of starting point for a lot of founders who might find that whole process very daunting and just not even know where to start. I guess how does AirTree kind of think about open source VC or kind of the sharing of resources and documentation in terms of just like what's the kind of strategy or kind of thinking about it, and how does that sort of fit into the broader sort of AirTree sort of model or ethos?
Yeah, I think it's super important to us. It's a core part of our belief that we should be able to demystify this process and make it as accessible as possible, as transparent as possible. As you mentioned, we've got a heap of resources on there. So the investor list I mentioned earlier, our seed stage term sheet, long form legal docs, an ESOP guide, and the reason why we're making that all open source and beyond just our portfolio, because we have a lot of resources we share with our portfolio, is we do think we have a broader role to play in the ecosystem to help the ecosystem grow and mature, and to make founders' jobs a little bit easier. It's really painful to start and scale a business, and if we can play a role in making that a bit easier, we think that's a really important role to play. And then also setting a standard. So particularly with the seed stage term sheet, the reason why we open source that is as a useful resource, but also so any founder, regardless of who they take funding from, can look at the term sheet they've got and then look at ours, which is very vanilla standard terms you'd expect to see in the Valley. Everything's explained in very simple terms. So you can look at them side by side, and if anything looks drastically different, to ask why. So you're at least informed, and I think that really helps set a standard for how we should all operate in the ecosystem. And I do think it's improved a lot, but there was a period in Australia's history where there was some pretty founder unfriendly terms in term sheets. So just trying to put that out there and saying this is the standard, this is how AirTree invests, and giving founders that benchmark.
Yeah, I think you kind of touched on, I think everyone who's been around the ecosystem for long enough has heard several stories around founders getting burnt through that process with just terms that really prevent them from getting follow-on investments or really kind of curtail their growth, which is not a great outcome for the startup and obviously for the early investors as well. And you kind of touched on the due diligence process as well. And obviously there's, it's essentially your role, and there's a very kind of clear due diligence process from an investment perspective, but it may be less clear for founders as well. And I know that you've put together a great sort of blog post on some of the process and some of the thinking that should go behind that. But I guess, what are some of the questions that founders should ask? As you mentioned, an investor sort of founder relationship can sort of be as long as a marriage and kind of be almost like a marriage as well. What are some of the questions or some of the thinking, or what are some of the things that founders should really try and gauge before they sort of commit to taking funding from an investor?
Yes, I think upfront, and it comes back to the point we discussed earlier around making sure that investor can invest in you, whether it's the stage or the industry. I think the other important point, and probably important whenever, but particularly during this time, is just making sure that the investor has funds to invest. So asking questions upfront around, when was their last investment? When did they last? You can do desktop research on when they last raised the fund and draw conclusions from there. But asking around their recent investments, how much they're looking to deploy this year, what their investment process is, and just sort of unpacking that to make sure you are using the time in the most effective way. And then in terms of the partnership, I've got a whole blog post that talks through how to think through the different ways that investors can support you and how you can test that. I would say the one, if you do one thing, it's to do diligence on your investor in terms of speaking to their existing portfolio. And I would suggest that founders approach this in the same way that investors should approach customer calls in terms of backweighting it in the process. So I wouldn't necessarily, unless you have an existing connection to that founder, in which case, of course, you can say, what's it like to work with AirTree if you know someone who's in our portfolio, and what's it like to work with that particular partner as well, and unpacking that. But otherwise, if you don't have a connection, then backweighting that in your process. So once you're down to, you might have a few potential investors you want to work with by the end of the process, and you might get a great situation to have a few different term sheets, is to have those conversations. And we have founders ask us, what's the weakest relationship you have with the founder, and can you make an introduction to that founder for me? So they want to unpack, and founders, should have a sort of list of questions that they'll ask in terms of how did you work through the hard times, how did you work through the good times, how did they support you, how did they add value? And so you'll learn a heap from that. That will be super useful in terms of what to expect when you become part of that portfolio as well.
Yeah, I think that's something that I think John, James, and I think from previous conversations you've mentioned as well is, AirTree really focuses on being kind of the first point of contact whenever something goes wrong or something goes right. And obviously, it's easy to kind of be there when things are going really well, but invariably, whether it's COVID, whether it's, customers just not paying on time, or, things not quite going to plan, there are a range of different challenges and issues that come up for founders. And I guess having someone who is understanding and supportive of that is super, super important. Is kind of doing founder reference checks the best way to go about that process? Or I guess how can sort of founders get a better understanding of the support that investors offer during challenging times?
And I think asking the investors as well to give specific examples is a super useful one. And we get asked a lot, how do you, what should we expect once we become part of the portfolio? How do you work with your existing companies? So obviously there's the formal board meetings. If there's a board seat or observer right, that will happen on a monthly or quarterly basis. But the majority of our founders, we have WhatsApp groups with and Slack channels, and lots of conversations that happen outside that formal structure. And that's where a lot of the value gets added. And as you mentioned, for us, how we think about it is we know we're doing our job well if we're the first call somebody makes when something great happens, and the first call something they make when something not so great happens. And it's a really flawed partnership if you feel like you can only share the wins with your investors. And I can totally understand why founders wouldn't want to be vulnerable and share the warts and all. But I guess we're all trying to, once they've invested, we're all trying to achieve the same outcome, which is a great outcome for that founder and that business. And so if we can work through challenges together, we're more likely to get to a better outcome. So for us, we know it isn't a rosy journey founding a company, and it's a roller coaster. And many people in the team have lived it themselves as founders, and so we have a lot of empathy for the founder journey, and it's a big part of how we want to work with our portfolio is being there during the tough times. And there will be many, and these last few months are an extreme example of that. But I think if you've got a fair weather investor, then it's a flawed partnership.
Obviously we've spoken a lot about what that investment process looks like for probably early stage companies or the first check-in through the door. How does that change from sort of subsequent rounds of funding? Like I know, AirTree's kind of model is really to get in early and provide sort of follow-on investments, but whether that's providing sort of follow-on investments for your existing portfolio or looking at sort of slightly later stage companies as well. What does that, I guess, what's the difference in terms of what you look for or how you sort of assess between different opportunities there?
Yeah, so when we invest, we like, as you mentioned, like to be one of the first checks into a company and then be there for the journey. And being a larger fund, we're fortunate we can continue to support a company through to their growth rounds. And so, and the way VC funds typically work is they'll make initial investments and then they'll have reserves. So reserves is a proportion of the capital that's reserved to follow on into their existing portfolio. So if you have a 10-year sort of VC fund, they'll typically be new investments are made over a period of 3 years, and the investment period will be 6 years. The remainder and funds will be typically raised every 3 years, so you constantly have new capital to deploy. But from that earlier fund, the latter 3 years in that 6-year period is primarily focused on follow-on investments, as you mentioned. So I guess up front we have a sort of reserve ratio. So based on the stage that we invested, we'll reserve a certain amount of money for that company for future follow-on rounds, and it's constantly reassessed. So we have quarterly meetings we go through and analyze what that looks like. It's quite a different diligence process, as you can imagine. We know the team really well. We've been working with them for years. We've had access to all the board materials and the financials. So we're a lot more up to speed on how the business tracks. And for us, if you grow as we hope, expect you to when we're writing the investment case, then we want to have the capital there to continue to support that growth over time. So for us, it's a matter of saying, okay, where was the business forecasting to be? Where are they? What's the potential? Has the landscape changed at all? Unpacking that, and then making an internal case. So we write investment papers for follow-on investments. It's a big part of our investment process. We've actually recently hired an analyst who we're starting soon to help specifically on this side of the business and making relative decisions across the portfolio for follow-on investments. So it's a big part of what we do, and it's a big part of the diligence you should do on investments too, is looking at who not only has the capital to invest now, but to follow on throughout your journey.
Obviously you kind of touched on the metrics and the data, and you've just got kind of more information to make decisions on as well. And I guess, again, from my own experience, I know that it can be kind of almost overwhelming, the amount of kind of metrics and information and data that you can sort of follow or focus on as a founder. How do you sort of think about, how should founders think about prioritizing metrics, or sort of identifying what the key metrics are that they should be focusing and honing in on for the growth of their business?
Yeah, and I think, I would say we often, as part of the diligence process, we're obviously unpacking this and trying to make sense out of the numbers as well. We often want to see how the founders think about it. So what are the metrics that you use to track your business? And that helps us to see a thinking process as well as what the actual numbers say. And then I'd also say with this process, sometimes we have very sophisticated data rooms that founders will share with us. And other times, founders will just open up, perhaps their chart mogul or whatever tool they're using to track their metrics to us. And that's a really great way to save the founder time in terms of pulling it out and packaging it in a different way. And then the investor comes back with questions and to-fro. And it's a very much a way to sort of establish this partnership around transparency, to say, here's our data, and we can use it in a way to unpack and understand what we're looking for. I think in terms of the metrics that are most useful, it really depends on the stage of the business and then the model that they're in. But if you're talking about a pre-revenue investment, we'd be looking for evidence that customers love your product. So, engagement metrics, how long are people spending in the product? How frequently do they come back? If you're tracking NPS and asking questions like, how disappointed would you be if this product no longer existed? We would love to see that data. And when we can sort of extrapolate from there and say, okay, well, if this was monetized in the future, what would that look like? They've created something really special, and that's what's going to get us excited. If it's post-revenue, then we'll look at the things that sort of are consistent across business models, as growth in revenue, churn or retention rates in the marketplace, but the churn for a SaaS product, looking at net and gross churn to take into account expansion. And we'll always want to unpack unit economics. So looking at how much are you paying to acquire a customer, and how long does it take you to get payback on that customer? So are you profitable on a unit level, and what does that look like? And it may be that the unit economics might not stack up given the stage of your business right now, but we can see a path to sustainable unit economics, and it's something that you're thinking through as a founder. So each diligence process looks totally different in terms of exactly what we'll look for, but they're kind of the fundamental things that will always be part of a investment committee paper when we put it together.
I think one of the things that often gets overlooked from a founder perspective when you're so deep on your own ideas, that there are multiple different kind of ideas and founders at the same time. I think one of your blog posts mentioned that you met with 200 startups in a quarter. And, oftentimes a lot of the ideas potentially overlap as well. How do you, I guess from an AirTree or an investment perspective, how do you sort of assess between similar deals, one that, is potentially pre-revenue versus one that's been in the market for slightly longer and has slightly more data points? How do you sort of differentiate between the two, if at all?
Yeah, I mean, for us, we're a long-term investor, right? So we're investing long-term fund, 10 years. So if the competitor is a few months ahead of you, we'll see through that because we're investing for the long term. And so then it'll come back to fundamentals. So who has a strong team and a clear vision for the future. And so even if the metrics is kind of here now, but we see that this team is well positioned, they've got great complementary skill sets, super passionate about solving this problem and have a very clear vision. And this company has slightly better metrics, but the vision's a bit unclear, the founding team isn't as strong, I would always go for that first one. So I guess it's seeing through, where the business, and that's a huge part of our job, is seeing through what the numbers say today and what it could be. It's very easy to say no to everything in our job if you can't see the future, and you could just say, okay, well, this business is further along, we'll go with that. But that's not our job. We've got to see what it can be and extrapolate some of those things, like a great founding team and a very clear vision for the future. So that's what will get us excited in that circumstance.
So a final question from me before we shift gears to audience Q&A is, how do I guess founders stand out for that initial sort of meeting as well? When your calendar is full and you've got an inbox full of 200 different sort of pitch decks and people wanting to meet, what are things that help founders to stand out in your mind to sort of prioritize them or just make sure that you make time for them compared to all of the other opportunities that you've got in front of you?
I mean, it helps if you've got a great business and a great product with a great vision for the future. I think that makes it super easy. But I think, like I said, sharing a quick deck ahead of time. So, and it's useful. Like I said, a quick no is painful, but it's better that an investor lets you know if you're not the right fit for their funds within their mandate. So sharing that ahead of time so that we can spend that time getting to know each other, I think is the most valuable one. And then coming prepared. I mean, to understand a little bit about the type of investments we make, a little bit about our portfolio helps to understand. But all this stuff is nice to have if you have a great business and you're solving a real problem and customers love the product that you've created. That's truly what's going to get us excited. If you don't have those, it's going to be more challenging. So I think there's things that you can do to make the process more seamless in terms of sharing materials ahead of the meeting and coming prepared. But ultimately, it's going to come down to how quality the business is that you're creating and the team that you've got around you.
All right. So we're going to shift gears to audience Q&A now. So just a reminder that there's a little Q&A tab at the bottom of your screen if you want to submit any questions. I'll just pick out a handful of these to ask Elicia for the remainder of this interview. So the first question comes from Anastasia from Flurosat, who's one of your portfolio companies. Wanting to know, what are some of the potential synergies between the companies in your portfolio, or between the companies themselves or the founders?
Yes, I think something that we've been experimenting with and kicking off more formally in the next couple of months is portfolio roundtables, essentially, or forums, where we get together similar skill sets from across the portfolio to share learning. So because we have such a diverse portfolio in terms of industries and stages, it's getting, let's say, all the CTOs together and founders. So we're going to cover founders, but also beyond founders. So the CTOs, the CMOs, the CROs, to share learnings and best practice. So it might be as specific as what tools are you using, it might be getting in external speakers, but it's really about helping that information flow across the portfolio so that one portfolio company can help another portfolio company see around corners and things that they might have done in the past that they can help the other company avoid. And there are things that, despite the fact they're in totally different industries and at different stages, they come across the same thing. Hiring is something that is just universal. So how to think through ESOP grants, or how to think through making an offer. These are the kind of learnings that we want to continue to facilitate across the portfolio. We've got 50 portfolio companies now. We'll add another 12 or so a year. So that breadth of knowledge will continue to expand. We've also got a Google group between all our founders where information will be sent across, and particularly during this time, there's been a lot of sharing of best practice and resources. So the way that we think about it is us as investors can add value, but then there's also a huge amount of value that our portfolio can add to each other, and trying to maximize the opportunities for that information to flow.
Speaking of learnings, and you touched on this a little bit earlier, but the next question comes from Fab Makoch from Dovetail, who also used to have a great podcast as well, and a good friend of mine. He wanted to know, are there any deals that you regret saying no to, and why did you decide to pass at the moment? And I think you kind of touched on the potential deals that you passed on a little bit earlier, but then decided to come in at a later round. Can you share what some of those stories are?
Yeah, I mean, we just, John and myself just published a blog, I think it was 2 weeks ago, around our investment in Quilla. And I know you had Mark on the podcast last week. So we actually looked at their seed round back in 2016. And funny story, I actually pitched Quilla to AirTree when I was interviewing in 2016 for the role. It was one of the sort of the case studies they gave me as part of the process. And Mark and Dylan, I did say to invest back then, so it was that's one vote of confidence. But yeah, we didn't get there in the end. And I think we saw a few more proof points around a few things, and we ended up making an introduction to Point 9 Capital, who ended up investing in that seed round. And we've stayed in touch with Mark and Dylan throughout the years, and they've done, they realised our no didn't mean a never, which is the important point I touched on earlier. And so they stayed close to AirTree, and then come their Series A, we ended up leading it. So that's on us, that we end up paying a higher price to get in at the Series A. But they've done phenomenally well to execute well since their seed. But it was that's a perfect example of us saying no, and then deciding to invest later on. So there's a blog post we published on that just recently.
Yeah, and I think that's also a really good point of the value that meeting with investors can also point to as well, is not just direct investments, but they might be able to introduce you to another fund that might be more relevant, or be more focused towards a particular industry or stage that you're at as well. So a no doesn't, as you said, a no doesn't always mean a no, and it doesn't also just mean that that's kind of the end of the relationship, and there's potential other value points that a VC can add.
Yeah,
well.
definitely.
Next question is from George from My Creative Box, who was also at the Investor Connect event. I don't know if you guys got a chance to meet last year, but his question is, particularly given the situation around COVID at the moment and some of the talk, especially, I guess there's an expectation that a lot of the angel funds or kind of very early stage funds will be sort of pulled out just given the uncertainty of the market at the moment. How do you think that, I guess, what do you think will be the market trends or kind of the shift for early stage investment in Australia?
Yes, I think, I guess from AirTree's perspective, we're fortunate we raised our latest 275 mil fund in October last year. So from our perspective, we have lots of dry powder to invest over the next few years, and we invest very early. I think a third of our investments in recent times have been pre-revenue. So, we're continuing to look to make early stage investments. I've written several term sheets in the last few months. In terms of the landscape beyond that, you'd hope that a lot of investors see this as a very long-term investment period. And I think there was a period of a huge amount of stability, particularly I think it's sort of late March, early April, where it's reasonable that a lot of the early stage investors or angel investors that might have been exposed to the public markets were taking stock of their positions and assessing how they make investments moving forward. And we've already started to see some of that correct, and we're still seeing angels make investments in lots of early stage funds investing. I think it just comes back to that point I made earlier around doing your diligence, and just check that the funds that you're talking to or the angel that you're talking to is continuing to invest through this period. We're seeing, I think there'll still be opportunities for great companies to get back through this time, and through history we've seen some of the greatest tech companies of all time get funded and founded during times like this. So it's inevitable that there's going to be a period of people reassessing. And I think also on the founder side, I would say a lot of founders that were planning on raising, in the next couple of months, have reassessed to decide whether they actually want to fundraise now, or whether they want to extend their runway a little bit more and have that run scenario models to figure out what that could look like. I think definitely from a funding perspective, the thing that has changed a bit is we're very keen to give our portfolio companies and potential new portfolio companies as long a runway as possible, 18, 24 months to get through this period of uncertainty. Private markets have typically lagged public markets in terms of the uncertainty. So what it could look like in 12 months' time, I think giving yourself more runway rather than less at this time is a good thing.
The next question is going to be a two-part question. I'm going to combine two people. One is an anonymous question that came in terms of what does it take to work in VC? And the follow-up question is from Jamal El Sheikh specifically around advice to someone who wants to start investing in pre-Series A startups. So assuming as an angel investor.
Yeah, okay. So in terms of VC, like I said, I can't say I had a perfect playbook for how to do that. I think I would approach it as what are the skill sets that you'd need to add value once you were a VC, and then building out those skill sets so that when the opportunity presents itself, you can make an argument for why you would be a good addition to that team and to support their portfolio. So, if you've started a business yourself, if you've founded a business, like that is super powerful, because you'll have a lot of empathy for the founder journey, which is a huge part of this, and you've got that experience that you can draw on. Obviously the financial skills come in handy. I wouldn't say it's an essential piece. You don't need to be a consultant or a banker to be a good VC at all. Some of the best VCs that have always been operators, and I think there's a lot of strengths and there's an ongoing debate as to whether being an operator makes you a better investor. But I don't think there's any clear-cut path, and I think that's what makes it interesting, is that people in this industry have a very diverse background and bring different things to the table. The way to, I guess, immerse yourself into this world, I would encourage people to go to events, and obviously they're all virtual at the moment, but going to events, meeting with startups, tracking some interesting startups, ones that you potentially wanted to invest in if you're an investor, and just really immersing yourself in this world, so that you're aware of the different funds that are available. There's actually, there's not that many roles that come up in VC funds across the year. So just knowing who the interesting players are, tracking interesting startups, having a genuine passion, which is obviously not something you can just sort of create out of nowhere. But if we can see a genuine passion for this space, for technology, for startups, that goes a long way. And then, like I said, the skill set to then help portfolio companies once they invest. So if you've got that operational experience, then building that out, so by the time you come to investing, you can really add value when you're sitting around the board table. And then the second piece, it's one of those things that encourage you to just get started. Is again, you need to really understand the key players, going to events, figuring out who are the most interesting startups, following the portfolio companies of the funds that have invested, meeting with existing angel investors to figure out how they got started, how they approached their first few investments. It's obviously typically sort of a portfolio play with angel investors. So thinking about how they got and modeling what sort of check size you can put in, and then being realistic about that, and being open with the founders around what you're looking for. And then starting to reach out to people. So I think a lot of that is just about networking. I would encourage you to add your name to the investor list that I mentioned earlier. So there's a whole list of angels on there. People add their mobile numbers and email addresses so people can get in contact with you. But it's really about making yourself accessible so that people can actually find you, and deal flow can come to you. And then figuring out what the right amount to invest is, and going from there. But it's one of those things that once you get started, you'll learn so much from that first investment and how it tracks. But if you can pick the brains of people who have been there and done it before, then you might save yourself some pain along the way.
The next question is from Simon Bernardino, and I guess one of the challenges that comes, and you probably would have seen this from your own portfolio, is just scaling your team is an extremely difficult exercise, and finding the right people to get to apply and join your startup is one of the most challenging parts of, I guess, a founder's journey as they sort of continue to grow and scale their business. What are some of the strategies that you've seen your portfolio companies use to help them onboard new team members, or kind of scale out their team as they continue to grow?
Yeah, and this is a consistent theme across the portfolio. As you scale, and often one of the first things you want to do when you raise capital is to hire great talent to scale the team. So when I first joined AirTree back in 2016, we saw this was and I'd come from the LinkedIn world. So I'd come from this area where I was talking to enterprise businesses about this, and I probably naively thought when I came into this space that, startups are super innovative, they would have all the tricks, they would know exactly how to do this. But the reality is startups are stretched for time, founders stretched for time and resources. So it wasn't long after I joined AirTree, we started to formulate this concept of an AirTree talent hub within AirTree. So we actually have Andrew Donald, who heads up our AirTree talent function, helps all of our portfolio companies with recruitment. So I don't know how replicable that is outside the portfolio, but that's something that we create as a value add for our portfolio companies. And so Andrew can headhunt and reach out to potential candidates, post jobs under the AirTree brand to help attract great talent. And then you can imagine if we're running a process for a CTO for one portfolio company and there's a great silver medalist, why wouldn't we share that with the other portfolio companies? There's a lot of synergies that we get. And then from a candidate perspective, knowing that they can reach out to AirTree talent and then get access to 50 of the hopefully best venture-backed companies in the country. So it's a great sort of talent magnet to pull into this sort of talent network, which works really well. Outside of that, so what's replicable outside of the portfolio, having a great culture and clearly communicating that goes a long way. So this is again something that I'm referencing in our Quilla investment blog post, which we posted recently. I'm just talking about the culture that they've created, and you can have a look at their team page. And I read their team page, and I'm like, gosh, that's the kind of company you want to join. And it's really about investing in your talent brand. And this is something I used to talk about with my clients back at LinkedIn. But it's really when you're a startup and you don't have the big brand name that large corporates will have. Why would someone want to work with you, and making sure that you clearly communicate that before a meeting. So, you can clearly communicate that in the first interview and get someone excited, but you need to bring people into the funnel. So how do you project that talent brand, and how do you get that out to top talent? So if someone does reach out to them about an opportunity or a job pops up, they're that much more likely to apply. And then obviously, actually having a great culture so that your employees say great things to them. Referrals is consistently one of the most high quality sources of talent. So encouraging your existing employees to think about, often great talent knows other great talent. So encouraging them to think about and consistently doing it too. It's not the kind of thing you do it once and then it's done, but reminding your employees on a regular basis to think who else they know in their network that might be a good fit, and encouraging them to come and meet with the team. So there's some of the little hacks that I'd recommend.
And final question is, I guess particularly for bootstrap companies that have been sort of growing organically over a period of time, who are potentially thinking about switching over and raising capital for the first time. This question comes from Claire Leeton. What advice do you have for founders who are potentially thinking about raising funding for the first time and might be a little bit further along the journey? How do do you have any advice in terms of how founders should sort of think about or approach that quite significant decision-making process in the journey of their company?
Yeah, so I would start by, particularly, I think this applies to any early stage funder that hasn't raised funding, but particularly if you've bootstrapped to a certain point, it's a really big decision to bring someone onto your cap table. We say investors are the employees you can't fire. When someone's on your cap table, they're there. And as we mentioned, it's a 10-year journey. So for somebody who's built a business for a number of years and had that, has owned the whole business themselves, it is a shift to bring on investment and to bring someone else onto that journey. So I would start by educating yourself on what that experience looks like. And so the open source VC content I referenced on our website earlier is a great starting point in terms of understanding how the term sheet works and what to expect in the investment process and what a partnership looks like once you invest. And it's really weighing up the pros and the cons of taking on investment and understanding what are the benefits you get just beyond the capital. If you've bootstrapped to that point, you're clearly producing profit to continue to grow the business. So it's just a question of how much faster could you grow if you had the capital behind you, if you could make those hires that much quicker than you could have otherwise, and then what's the additional value the investor can add beyond just that capital, which might also help accelerate your growth. So educating yourself. There's also a very good book called Venture Deals by Brad Feld, which goes through all the sort of terms to expect throughout a fundraise process, how to think about the different roles in a VC fund. And it's super useful. I listened to it as an audio book before I joined AirTree on 2x speed, I think, and then it was the kind of thing you needed to go back and actually, it's got a lot of legal terms and actually read properly with a highlighter. So that would be a super useful one. And then final tip would just be speak to other founders who have been through that journey, particularly founders who bootstrapped for a number of years and either decided to take on capital or decided not to take on capital, and learn from their experience. So this world, it's great to see how collaborative people are, and people are generally pretty open to a coffee. So feel free to reach out and hear about their experience and why they made the decision they've made, and whether they have any regrets or whether they would change anything, and try to learn from their experience.
On that note, Elicia, thank you so much for coming on the show and for sharing your experience and insights. And thank you to all of you that tuned in this morning as well and joined us for this early start for the podcast as well. So this episode will be edited and published onto all major podcast feeds on Thursday. before we head off, just a quick note. So this is part of a weekly series that we that we launch every Tuesday at 8 a.m. And the next guest that we have is Malcolm Turnbull, the former Prime Minister of Australia, who is now also an investor. Obviously best known for his time as the 29th Prime Minister of Australia. But prior to that, he was an entrepreneur and investor as well, including one investment into Aussie Mail, which turned a $500K investment into a $60 million return, which is a fairly sizable outcome. And he's since leaving politics, he's jumped back into focused on investing into tech startups such as Myriota as well. So very excited to have Malcolm Turnbull on the show. If you'd like to join us, we go live Tuesday, 2nd of June at 8 a.m. I'll share a link to everyone that registered to this link. But on that note, Elicia, once again, thank you for joining us this morning. That's been extremely insightful. And once again, thank you all for joining us, and I'll see you next week.
Thanks, Rohit. Thanks, everyone. Bye.
Bye. Thanks for listening to episode 113 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back at 8 a.m. next Tuesday, the 2nd of June, with another live episode. And my guest for episode 114 will be the former Prime Minister of Australia, Malcolm Turnbull. Malcolm is best known for his time in politics, but prior to this, he was a successful entrepreneur and investor, including a tech investment of $500,000, which resulted in a $60 million return. Since leaving politics, he's doubled down his focus on tech investments. I'm really looking forward to the interview and hope that you can join us. But in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.